Welcome everyone back to the channel. So in this video, I'm going to be answering a lot of people's questions, which is, can you use order flow to trade gold or gold futures, right? So if you're a gold trader and you trade either the London session, the New York session, or even the Asian session, then I want you to pay attention to this video because you absolutely can and should be using order flow to catch moves on gold, right? So I'm not a gold trader, but the same concepts I use on the S&P 500, you can apply them to gold, right? Gold is nothing special. It works the same way and you use the same principle. So in this video, I'm going to be breaking down a case study on gold, right? So specifically, I'm going to be talking about Wednesday, the 13th of November, right? So this is where the market tanked after creating an all-time high, right? Or sorry, not all-time high, but this is basically where we were in terms of the structure. So the way that I like to start my trading is I like to look for the 4-hour lows and 4-hour highs, right? So I just want to mark this up. This would be my structural high. This would be my structural low. So this is our structure. This is our dealing range from this high down to this low. And so this is how I would determine that. So this trade on Wednesday, the 13th of November was actually in premium and therefore we target discount. That was sort of the higher time frame analysis. So it doesn't take long to find a higher time frame bias if you know what you're doing. But when it comes to execution and when it comes to how I trade, it's actually quite simple. And I want you to just take this video and understand how simple it is to read any market with order flow. Now, when I start my trades, I always start with this same simple framework, right? So you need to know where to trade from. You then need to know what to look for. And then lastly, you need to know why you are looking for it. So this is the where, what, why framework. I call it the triple X model. So this is the triple X model. Now, specifically, if we look in further, what we're looking for is you need to have a key level, right? This is important. So you need to have a key level. You need to know where to trade from. You then need to know what you're looking for, right? So we're going to be looking for specifically buyers versus sellers. And the last thing you're looking for, most importantly, is you need to know why to take, in this case, a sell. You need to know why you are selling and vice versa, why you are buying. It's the most important thing, but everyone screws up the why. And I'm going to be breaking it down in this video. So if we go now to gold on this particular day, so I only trade the New York session, right? S&P 500, I only trade the New York session. But coming into this day, so this is now 1 p.m. in the UK, so this is 8 a.m. Eastern. So first of all, I want to understand where the Asian range was sitting, right? So the Asian range, I use it, my Asian range specifically, I do from 1 a.m. in the UK, so that's going to be sort of, well, here, right? So this is going to be my Asian range over here. So it's just basically the session before London, right? So your timings don't have to be super accurate like they say on Google. You just need to know where the overnight highs and lows are, right? So this is how I'd have my Asian session. Now, specifically what's happened here, if I just play price on a little bit, we had this sell-off in the New York session. So we're looking to catch essentially some of this move. So this is the distribution in red, right? So in ICT terms, they call it accumulation, manipulation, and then distribution, right? So this would, I guess, technically be your manipulation. Now, in order for you to catch this move, right? So this is the distribution, right? You first need to start off with an accumulation. This is what I call a one-phase manipulation. And I'm going to be breaking down why that is a one-phase manipulation. Simply put, it's because we've only taken out one side of Asia. So this is one type of daily cycle that I use, right? Daily cycle meaning if this is sort of if we just take out our daily power of 3, it will look something like this. So we go here, we tick 1 day. This would be our daily opening price. So I just use the PO3 tool or the PO3 indicator. In TradingView, you can get it like this. So if you just type in PO3, you should see an indicator down a high HTF power of 3 by 2 degrees, right? It's that simple. So this here would be your daily opening price, right? So this would be your daily opening price. So it would be DOP, right? So let's just label that in DOP. Now, the whole point of having the daily opening price is you want to be selling above the daily opening price, right? So if this is the daily opening price, there's no point trying to catch an expansion down here, right? There's no point even trying to catch the expansion at the daily opening price. You want to be selling somewhere, ideally above this daily opening price, so you can catch the move or catch some of the move, right? Catch some of the distribution, right? And that's what we're going to be going through in this video using order flow. So the first thing to understand is you're looking for, and this is how I approach my charts every day, you're first looking for a 15-minute FEG or a 15-minute imbalance, right? So 15-minute FEG like this. So when you have the 15-minute FEG, this is how I do it, right? So I would go to New York session. So New York session would be 8 a.m. Eastern or 1 p.m. in the UK. And what I'm looking for is I want to look for a 15-minute fair value gap. Now there's a few which you could identify. Now one of them is here, but the problem is this fair value gap has already been mitigated, right? Right, that's the first thing. So the second thing is I'm looking for an sort of an unmitigated fair value gap. So there's a small one resting over here, right? That is my fair value gap, right? I'm going to label it in blue. So my favorite way to use fair value gaps, and I think it's the best way to use fair value gaps, when you're finding a key level, you want to take the candle before the fair value gap, just like this. This is going to be my key level. So that's step one to the equation. That is step one. You must wait for a key level. That's step one. Step two is you're waiting for price to enter the key level. So you're waiting for an entry, or I like to call it a PO3 entry. The reason I call it a PO3 entry is because the entry has to be aligned with the higher time frame PO3 or the higher time frame candle. So in this particular case, what we have the daily opening price, which I spoke about earlier, which is down here. So this is the daily opening price, this red line. Now the reason I like this level is because I want to be selling above the daily opening price down to the Asian range low. That is the thesis of the trade. Now, this alone isn't enough to get you into the trade, because the last thing we're going to be looking for is order flow, or specifically it's just confirmation, right? So 15-minute fair value gap, you wait for price to enter that fair value gap, or specifically this order block or this key level, and you use order flow at the key level to determine whether you want to buy and sell. That's how every trade I take is taken. It's using these three steps: 15-minute fair value gap, entry, order flow. It's that simple. So now, if we break this down, we're just waiting for price to come in. So when I trade, right, I'm waiting for that New York session, or specifically I'm waiting just for a break and retest. So let's kind of break this down. So for me, I want to see a break with a candle. That's the first rule that I have. So I am interested in this now. So if we just break this down, this would be the break below the zone, right? So this would be the break right here, right? So this would not be a break for me. That's not good enough. I want to see this as the break. So this would be my break line. Now the reason I have this break line is because I see a lot of traders, what they'll do is they'll try and enter here. They'll try and do something like this, and they'll have their stop loss here. And what happens is the trade does go through a lot of choppiness, right? Sometimes you get stopped out, sometimes it goes and then you get stopped out. So, and then it just becomes a mess, right? And I don't like entering early. So there's an easy way you can fix FOMO. There's a very easy way you can fix FOMO. And the way that I do that is by drawing this line. Now I call it the break line, right? Nice and nothing fancy. I just call it the break line. So what that means is you're looking for a break and a retest. You're looking for a break and a retest. So this is the break. Now, when you have a break, you just draw a line underneath like this. This is the break, right? This specifically is the break. Now, what's important to understand is you want to see what is going on inside of the key level. You're not interested in what's going on up here. You're not interested in what's going on down here. And this is the beauty of the strategy. This is the beauty of the XXX model. Once you have a key level, you're only interested in the order flow at that key level, right? And speaking of order flow, we're really going to break this down. So how would I enter this particular trade? For me, this would be the entry there. And I'd have my stop loss just above. I wouldn't have it all the way up here. I'd be comfortable to have it either here if you're more aggressive, or somewhere here. And then we just target, like I said earlier, we target the Asian range low. So that Asian range low is down here. So that's about a 1 to 2.5, right? 2.5 risk to reward. Now, like I said, this here is not enough. So if you take trades like this, it's not enough. What you need is a break, and you also need a retest. And so this entire region in yellow is the retest. Now, what do we look for inside of a retest? So this is where we use our ATAS platform. So this is the ATAS platform. It's the same exact chart, right? So what we can see, this is the 5-minute chart. Now, on the 5-minute chart, we have that same key level derived from a 15-minute fair value gap. And what we're looking for is we want to see how price behaves after the break. So we're looking at this candle, and we're looking at the local price action, right? We're looking at this local price action. So let's just dive in and see what we have, right? So this is now 9:10 Eastern. This is now 9:15 Eastern. So I'm very interested in looking at this candle here. So this is a red candle, but look what's going on over here. So this is what we're going to break down specifically. So again, if we just go to the 5-minute chart, right? Let's kind of break this down. So we want to focus on this area. So we want to focus on this particular area. So what was going on here, right? What was going on here? This is an important area to understand. Now, for the traders who don't understand order flow, right? I'm going to make it very simple. When we break below a level and we have a retest, we are looking for aggressive buyers over here to then fail. And this would be our break line over here. So the way that a break and retest forms, let me just draw that again. The way that a break and retest forms is you need to understand that buyers have to be trapped. Now, this is what creates the selling environment for us to sell, right? This is what creates the selling environment. Now, in this region, what we're looking for is this, right? We want to see aggressive, if I spell that, we're looking for aggressive buyers. That's kind of step one. We're looking for aggressive buyers in and around this region. So if we go back to the ATAS platform, what we see over here is the following, right? If we just kind of break this down, now without even reading the numbers, what we can begin to see just from a delta perspective, right? Look at this retest over here. So this is the level on gold futures. This is the level. So we've come into this fair value gap, or we've come into this order block. Now, what do we see inside of this order block? So what we can see primarily a lot of blue delta. Yes, we see one red, but we see primarily blue delta. So this candle here, this retest candle, again, same with this one. If I kind of break it down, same with this one. These two candles are the retest candles. So this is 10 past 2 p.m. in the UK, or 9:10 Eastern, and this is 9:15 Eastern. So these are the two 5-minute candles. So this is 9:10 Eastern, 9:15 Eastern. So these two candles here are very, very telling of what's going on in the price. Now, 4 for 29. This is a very, very strong positive delta. So what does that mean, right? So if you're a gold trader and you trade any kind of strategy, I don't care what the strategy is, you can combine order flow at your entries or your reversals or your retest areas. So if you're any kind of trader, ICT, smart money concepts, doesn't really matter, harmonic patterns, Elliott waves, none of it actually matters. What you need to focus on is rejections and reversals. And the best way you can find this is simply by using the delta at key level. So it doesn't matter whether you trade footprint charts, depth of market, bookmap, they all represent the same data, which is aggressive sellers on the left, aggressive buyers on the right. It's the bid and the ask. So specifically, if we look at gold over here, we're going to go through these three examples. The first example is 4 for 29. So that is roughly a 7x difference, or just over a 7x difference. There are 7 times the aggressive buyers as aggressive sellers, right? The bid is smaller than the ask, or in other words, the ask is a lot greater than the bid. There are a lot more aggressive buyers going in with market prices. So this price is 42.25. We see a lot of aggressive buyers compared to aggressive sellers. We see the same thing over here. We see double, 13 for 26. There's double the amount of aggressive buyers than sellers. Now this is again 42.24. So 42.24, 42.25, and right over here we see 6 for 24. So this is also 42.25.2, right? We see 6 for 24. That is a 4x difference. You don't need to read all the numbers. You don't even need to read half the numbers or a quarter of the numbers. You need to train your eye to spot the delta inside of the key levels so that you can see who is aggressive. Now, this is important to understand. If you can see who is aggressive inside of these key levels, that will then show you who is being absorbed. Now, this is what's important. Just from a common sense perspective, right? Just from a pure trading logical perspective, if we know that 42.25, 42.24, if there were a lot of aggressive buyers over here and the market breaks lower, right? That break line over here, which corresponds to that break line which I drew over here, just over there. If we see a lot of aggressive buyers, right, and we see downside follow through, right? Or downside, I'm just going to write downside move. You want to ask yourself, were those aggressive buyers successful? It's a very simple question. Were those aggressive buyers successful? No success, right? So I'm just going to write no success of buyers, right? And this is very important to understand. If you're looking for a rejection or a reversal on gold or any kind of asset class, you need to fundamentally have your key level, look for buyers and sellers inside the key level, and see who is aggressive and who is not being rewarded. Now, this concept of who is aggressive and who is not being rewarded, we call this absorption. So no successive buyers, right? What we call this an absorption. Specifically, it's an absorption of buyers. So I'm just going to write absorption. Now, this is how you spot the absorption, just like this, right? If we just go into the key level, again, we're only interested in inside the key level, so we're not interested in everything. Again, likewise for this particular candle, we see the dark blue over here, so we don't need to focus on all the numbers, right? So these are the questions I get. You don't need to focus on all the numbers, you just need to focus on a few, right? The footprint charts will tell you who is aggressive inside of the level, so you don't even need to go searching for the numbers. What you need to search for is the delta. Now in this case we see 11 to 55, that's a huge difference, a 5x difference, and 17 to 49, that's roughly a 3x difference. So again we see tons of aggressive buyers and no reward because we're breaking below the zone. So what does that tell you? Buyers are being absorbed. Okay, now for me, I had to go over this because this is such a key critical example here, right? Look at this, we break below the initial break line, right? So this is very, 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 very important to understand. So if I just bring this over to the right now, what we're seeing is we see price breaking, we have a retest candle on the 5-minute, and then we break below. So what's important to understand, if we look at this break below candle over here, right? So this is where we started to have that downside follow through. What's so interesting, if we bring the chart side by side, we have our retest candle, second retest candle, then we break to the downside. So we can see a red candle, generally lower prices, right? And then again, lower prices. What do you see there, right? So this is 42.21, right? So again, this is, I think, well, it's slightly different prices, but it's the same asset class. 42.21, which is around here, right? Here or somewhere around here, 42.21. What was going on at 42.21? Let's have a look. 7 for 370. Look at that difference. This is even more extreme than what was going on inside of the key levels over here. Here we had tons of positive delta, right? This here was massive. Whatever the math is, you can do the math in your own time. That is roughly a 7 times 3, 7 times 4, 7 times 5, 7 times 5 is 35. That is roughly a 50x difference, or just over a 50x difference. So much so that I'm going to write it down. So it's 7 for 370. Now, what does that mean, right? What does that mean? So we had a lot of blue delta over here, right? So I'm going to label that in blue, where we had lots of blue delta here, and we also had a ton of blue delta, huge amount of blue delta over here. So this is the same principle. It's the same principle of seeing aggressive buyers, but we have downside follow through here, we have downside follow through here. So aggressive buyers, downside move, which means that those buyers were not successful. These are unsuccessful buyers, which means they've been absorbed, right? This is the absorption principle, everyone, and this is what I want you to understand. If you want to catch the distribution, know where your level is going to be and actually have confidence in knowing whether that level is going to reverse. So if you trade gold, I want you to make a promise to yourself. Go and add order flow to however you trade. I don't care how you trade, just go and add order flow, right? I specifically use fair value gaps because I think they're simple and fast to implement, but you do not need to copy me, right? You don't need to understand fair value gaps in this way. You just need to have a strategy that works. You just need to have a strategy that works. And the best way to really get that, in my opinion, is to truly understand who's in control of the price, right? So if we just play price on, we can see price nicely comes down to the Asian low, just like that. So it's a simple concept of accumulation, manipulation, and then distribution. Now, in order for you to catch the distribution here, I can't stress the importance of these charts over here, right? So it doesn't have to be the ATAS platform. I'm not plugging the ATAS platform. You don't even have to use footprint charts. You can use a depth of market. You can use the Bookmap. You can use whatever order flow tool you want, as long as you have as long as you have a fundamental understanding of what was going on between buyers and sellers, you can trade successfully.